Welcome to Phil's Gang videos. My name is Phil Grande, Phil's Gang. I'm going to bring you up to date as to where we are with this stock market crash. However, Phil's Gang, we don't call it a crash. We call it a correction because we're making money as this market continues to drop. Remember what a correction is. A correction is like you fly an airplane, you're a pilot, and you're going off course, you correct it, and you're nice and safe because you're a professional. The pilot, who is not good at what he's doing, he tries to correct, but he can't do it well, and he ends up in a crash because he loses total control of the airplane. It's the same thing in piloting the stock market. It's all we're doing. We're investors. We have some good investors and some bad investors. The good investor, he's always in control, whether the stock market's going down, the stock market's going up, and he makes money both ways. The person in non-control doesn't know what they're doing. They always end up in a crash. They always have investor error. Well, let's go back and start with where we are today. We got to go back in history to learn why we got here. First of all, we had, as you recall, this is our third bubble. We had the tech, we had the housing, and now this is the QE. You'll notice in the QE is different. QE is different than the others as it is much higher. It's going much higher than the other rallies, and I'll explain why. But first of all, we got to go back and take a look at what happened when the market started to crash back in here, the housing market. And we're going to do that by bringing up this guy. Okay, so in November of 2008, they did QE. Now, wait a minute, QE. Why QE? Because Bernanke, remember, this guy here, okay, Bernanke, what he did is Bernanke told Greenspan when he went to study QE in Japan, he said, I would never do QE because what I found is their economy hasn't grown in 20 years. They can't get out of recession because of QE. All QE did in Japan was help the 1 percentile, the elitists, get very wealthy in the stock market. That's all it does. It doesn't grow the economy. It doesn't help the economy. And it's devastating towards the economy. It just helps the 1 percentile. I would never do that. Well, that was music to Obama's ears. Because remember, at the end of November 2008, we had Bush still in the White House. Obama was taken over in 2009. It was music to his ears because remember what he promised. He wanted to change America. He was going to change America to a socialist society. So he didn't care about jobs. But what he cared about, what he heard was how it would make the elitists very wealthy using QE. Well, he didn't want jobs. We know that. So he said, this is great. Everything lined up perfect for Obama to pay back his elitist people who got him into office, the Pritzkers from Hyatt, the Soros, the Buffetts, and a whole bunch of them, and he could repay them now. And that was the purpose behind QE, to take the 1 percentile, move the stock market up, and repay these people with $5.6 trillion. That's right, $5.6 trillion is what these people made. And the public, you and I, we got wiped out 12 trillion during this mess of the stock market crash. And during the QE, we lost another 6 trillion compared to what they made. 2 trillion compared to what they made, which was $6 trillion. Okay, so here's what happened. The first thing they did was they decided they would tell a story. And the story would be, Bernanke said, we're going to drop interest rates at all the small banks, okay, from the savers. We're going to drop the interest rates that were at 5.25% that your small banks had, okay, 5.2%. That's what all the small banks in your hometown were giving you on your CDs and savings. And they're going to drop that to 2%, 2.25%. So let's say zero interest. That's where they came up with zero interest. So they dropped to 5.25 for your savings, and now you're only getting 0.25. And the reason for that is because we're going into a recession, and we have to pay $250 billion a year in interest on our $18 trillion loan. And normally we pay that okay, at the same rate of our 10-year Treasury, which is about 2.5%, 3%. Because we don't want to pay 2.5%, 3% because we're in a recession. We steal monies from the savers, and we only pay them 2.5, and the 5% we take and move over here, and we pay China the interest of 250 billion. So we steal it from the savers to give to China, who loaned us the 18 trillion, which is 250 billion a year in interest. So that's taken care of. Now again, Bernanke covered it by saying that this would help all the small banks now, all your small banks here. Okay, they'd be loaning for cars and snowmobiles. Everybody would be excited. Interest rates are so low that they would be helping us stay out of the recession because the interest rates are low. That was a bold-faced lie, because Bernanke said to the big banks, J.P. Morgan, Goldman Sachs, Wells Fargo, and the rest of them, don't you loan to these Main Street banks, okay, because they're too weak to people. What we want you to do is this. We're going to loan you money, and we're going to call it TARP. And we're going to lie. We're going to say the 750 billion TARP was to help bail out all these homeowners, but we're not going to do that. After we get it through Congress, we're going to tell them to stick it, and they did. And then we're going to take the 750 billion and we're going to give it to you guys, the city, J.P. Morgan, the rest of you. And here's what we want you to do with it. Pay yourself your Christmas bonus and so forth, but here's what we want you to do. We want you to start investing in commodities. Why? Because China's economy was going to start taking off in 2008. You see it right over here. Okay, so China's economy was taking off, and the reason it was taking off was because they were in a massive infrastructure construction, because they were building cities all over China, massive cities, and they needed oil and copper and all these commodities, and that would help, of course, our big companies like Exxon and the rest of them, Freeport McMoran and the rest of them. So that's where the money went. So they bought all the commodities, oils and stocks and copper stocks and all the other stocks out of the 750 billion the banks, and they also were lending money back to the Fed. What do you mean? Well, remember, the Fed loaned them money at 2.25%, the bank. Well, the Fed said, we'll buy it back from you immediately so that you can make money, and we'll buy it back from you at 4%. How about that? What a good deal that is. The bank gave the bank, Citi, Wells Fargo, and the rest of the money at 0.25, a 0.25%, and then they loaned it back at 4%, and they made 4% profit, the banks. Now, the reason they did that, and the reason why they're being commodities, between buying the commodities and buying bank stocks and getting their 4%, then all of a sudden the stock market stopped going down. And now all of a sudden the bank stocks lead the way. So the banks went up 400% because of that. Now, on top of that, they decided to do QE1. Now, remember, Bernanke said QE1 doesn't work. It only helps the elitists. And so, of course, Obama liked that idea, because now the stock market was going to go up, and the elitists, the 5 percentile, the 1 percentile controls 85% of the stock market. So they stuck another $1 trillion into the stock market. So China's on its way, helping pull our market up, and we're sticking in $1 trillion on top of the 750 billion that was going to the banks to buy commodities and so forth, and to also buy stocks. So all of a sudden we had QE1. Things were going good, and it ended in March of 2010. Stock market started to drop again. They put in another QE2, 650 billion. Same thing happened in 2011. We started to drop again. They put another 400 billion in September 2011. Stock market started to drop again, and then they finally put in another 1 trillion. And at that point, in 2012, we spotted that China was having a problem. China's economy is starting to go down. What we found out is that during this whole boom, just like Bernanke said, it wasn't helping the economy, it wasn't creating jobs, and Obamacare was killing full-time jobs, all part-time jobs, and that's what was happening. So now they've been lying to us all along, telling us the economy's doing good, our labor market's strong, when it's all part-time jobs, and we weren't growing, our economy wasn't growing. Our economy back here was at 2%, all the way up to where we are today at 2%, and our economy never grew. because Bernanke said it would never grow because it didn't grow for Japan, didn't grow for us. And now now China was having problems because our wages weren't growing, our economy wasn't growing. We were their biggest customer, and then China's stock market started to go down, their economy started to go down. And so what do? Now that we were finished QE3, they said, well, let's start a big stock buyback program. And a stock buyback program, companies, because our consumers didn't have any extra cash run after they pay their bills, and the stocks needed to go up. So all they did is buy their own stocks to push their stocks up even further. That's called a big bubble. Well, let's go back to 2000, and now we reach 2014. Now we're starting to see. Now remember, this was in 2012 when we saw China's economy going down. Now we get to 2014. China's getting worse. 2014, we see the first sign of a stock market crash. What happens is the New York Stock Exchange, we see that New York Stock Exchange, they couldn't break out. They couldn't break out, make new highs in July 2014, September, December, and finally February of 2015, they broke out. In the meantime, in February, if we go back to February, okay, as we got into February, if you look over here, okay, the market right here started to, and if you recall, and as we started to move higher in the market, right here, back in 2014, we had this pullback. This was the same time that we could not break out from September to December on the New York Stock Exchange, because as the stock market was going up, we had less and less stocks making new highs. That's when, at the same time, we started to drop in our market. The S&P started to drop right here, and you can look at the date. That was in October of 2014. So remember, this was first July. This was July until December. So right in October, this is right here, October, just the same time we were having trouble here. In October, our market started to fall apart. Bernanke came in, pushed the market back up with stock buybacks, and then we got to the point where all of a sudden we started to go sideways again. Anytime you start to see a market going sideways, that's a signal there's a problem. Anytime you have a market that goes up that has what we call a nice move, where it's a nice tight grouping like this. When you have a nice tight grouping like this is a consensus. Things seem to be going good, but when it stops, goes side, that means there's internals breaking down. All of a sudden we break out, and we start breaking out, and we look, and if you look, this was the breakout came right here, right in this grouping right here. That was, and I'll give you the date. Okay, this date here, we started to break out, and that was right around February 2015. And that's when we finally broke out on the New York Stock Exchange at the same time. So the New York Stock Exchange breaks out, and we break out, but there was a problem. And I told everybody this. I said, wait a minute, this 7% rally, this big move, 25% of it was Apple. And if something happens to Apple, our market would collapse. Well, all our big investors spotted that, and that's why we couldn't break out now on the S&P. We couldn't break out in the New York Stock Exchange. Now we can't break out in the S&P. Come July, the last week of July, we had the biggest dump in stocks. And I told everybody, hey, that's the beginning of the stock market crash. You can go listen to my video. So this is the first part of this crash has begun the last week of July. Everybody, all the big institutions were dumping. Oil was going down. Commodities were going down. Everything was going down. And then all the big institutions started to dump. And they continued to dump. While CNBC kept telling us our economy was in really good shape and we're going to go much higher. So what does this all mean now? Where are we today? Well, what it means today is I think we're going to go down to this 190 area right here, 190. Okay? And then we got to see. Are they going to come in with QE? I think once we hit the 10% here, we already hit 10% on the Dow. We hit 10% on the S&P, then we'll start seeing some rallying going back. They're going to try to push this market back up. All right, and they either got to come in with QE to push this baby back up. If they raise interest rates 0.25%, then the market will go down another 10%. I don't think they're going to raise rates because they know that. If they do, they're out of their mind. Now, the reason why they say they're the big problem, all this, because they held interest rates too low. Remember, when they dropped rates from 5.25%, it was only supposed to be for a few months. It went to 6 years. And that's how they stay out of recessions, by dropping the rate from 5.25 down to 2.5 for a few months to try to boost the economy. 6 years, they never brought the rate back up. So that means when we're going into a recession, we have no bullets left. See, they dropped this rate to stop the recession. Okay, but now we have nothing to stop the recession. That's why we could go down 30%. So it's going to be interesting. So let's see what happens when we hit 190, and then I'll bring you up to date once again. See you on the charts.